Hiren Vaid is now joining us. He's a market master of the day, Chief Executive Officer, Director and Chief Investment Officer at Alchemy Capital Management. Hiren, good morning. Good to have you with us here. Thanks for your time. I just want to start with your view on mid-caps and small caps, Hiren. 20% on small caps last 2 months, 17-18% for the mid-cap space. We had someone like Lawrence Belanco, purely chartically speaking, saying, well, he's projecting much more gains here, while he thinks large caps will be ranged. What's your view on this space and what's likely? It's a very varied space, so we'll have to maybe, if you're okay with it, talk bottom up as well. But first, a top-down view. After the run-up that we've had, what's the view?
So, Prashant, thanks and good morning to all your viewers. Thanks for having me on the show. I think the small and mid-cap space went into a long consolidation correction phase from October 21 right up until March of this year. And I think what was ailing the sector last year was the fact that we had a big impact on, if you look at the non-financial companies in the BSE 500, if you look at the 420 non-financial companies, last year in the first 3 quarters, you had almost a negative 550 basis point contraction in EBITDA margins because of rise in commodity costs, energy costs, power costs, logistics costs, right? So there was a negative operating leverage as far as earnings was concerned. And you also had rising rates, which means that typically small and mid caps don't do very well when rates are rising and cost of capital is rising. So you had a double whammy in terms of negative operating leverage on earnings, plus some contraction in PE multiples. But I think if you look at the fourth quarter numbers that the earnings season just got over, I think broadly the non-financial companies have clawed back about 150 basis points of those margins back, with a combination of the fact that raw material prices have started to soften, and companies may also have taken some price hikes. And I do believe that this trend will continue into Q1 and Q2 as well, because we are not done. I think commodity prices continue to soften, and I think the full benefit of that will flow through into Q1 as well. And I think broadly it would be safe to say that we are almost towards the end of the rate hiking cycle, right? So I think the combination, what ailed this the small and mid caps last year is actually likely to be a tailwind this year. And there is no doubt that the breadth of performance has improved and the breadth in the market has also improved substantially. So we are very, very bullish on small and mid caps going forward from here. I think this is just the first leg of re-rating after a long consolidation and correction.
All right, this is the first leg of re-rating. So within mid-caps and small caps, Hiren, where do your preferences lie? There are many pockets that have already delivered great returns, right? We were just talking about the auto sector, stocks like TVS Motor hitting fresh lifetime highs. We were speaking to a management that's in the defense space, and he said that, orders are coming in thick and fast. But these are spaces that have already run up. Where do your preferences lie now?
So, Sonia, I think if you look at a slightly longer term view, our view is that the sectors that did well in the bull market of 2003 to 2007, right? Capital goods, infrastructure, defense, manufacturing, autos, auto ancillaries. I think very similar to that, we believe that these sectors will come back in favor. They have gone through a long phase of consolidation where nothing happened for the last 10 years. We had a lost decade of manufacturing in India between 2010 and 2020. And now I think that there is a regime change that we see, and we believe that broadly manufacturing, but a lot of these sectors that I spoke about will likely lead in the next bull market rally. And I think the interesting thing is that in the small and mid caps, you can find a lot of companies, whether it is in defense or capital goods or power or EPC or infrastructure or cement or manufacturing. I think you will see a lot of action in those sectors. going forward from here.
All right. Hi, Hiren. Just hold on, Hiren. You know, seeing a couple of large trades actually. Man Infra as well is seeing a big trade that's taking place out there. So this morning, a couple of large trades being seen. Man Infra is the other one. Fair, I think, a few lakh shares actually have got traded in the last few minutes. Maybe we get the block deal alert. It should come up for you on the screen. Well, Hiren, the markets in at least FY24 so far, we're only 2 months into it. The mid and the small cap portfolios are feeling quite good. Towards the end of last year, you'll ask a lot of retail audience out there, they'll be like, hey, we don't care if the markets are at 17 or 18,000. Our portfolio is more like 14, 15,000. What's your view, though, on these new age themes? Some of them have come back pretty well, though, stocks like Paytm are still a third of what they were at the IPO price. Would you look at them, or there are much better opportunities, like you're talking about manufacturing, defense, etc.?
So I think, I think earlier in your show, I did mention that late last year, in fact, we did make some investments because that to us was the most hated end of the market, right? From being the darlings in 21, these stocks had corrected massively. And as you know, that valuation swings on both sides. And we got some great entry points in not all of them, but some of them last year. And now I think we are seeing that as these companies are hurtling towards profitability and focusing on not wasting capital in too many areas, we think that over the long run, there is still money to be made. But the problem in this area or in the new age sector is that there will be continuous supply of stock from existing investors who may be wanting to get out. And that's fair. And therefore, you need to be very careful while trading into this sector. But we do believe that, 3-4 months ago, the valuations were very, very reasonable. And there was a good entry point into some of these companies.
Hiren, what are the what's the not new but themes that you are now really excited about, apart from what we've already spoken? One is I'm starting to hear power more and more. Things like pump storage within power is a theme, and some stocks likely to benefit disproportionately. What are you focused on?
So Prashant, for example, yes, I think power will do well. Our framework doesn't allow us to end up buying the end power utilities, but through the value chain, there could be a lot of opportunities. I think an area of opportunity that we are liking now is that, there were certain areas of discretionary consumption that didn't do well, right? I mean, consumption just fell off the cliff after Diwali last year. And trends have been very, very soft. And those stocks haven't done that well. And I think from a risk reward perspective and slightly longer term, while manufacturing and capital goods and defense are all at highs, and that's a structural story, I think some high quality QSRs or consumer discretionary companies or large box retailers, which haven't done much for the last couple of quarters, I think that there is an opportunity that we see there, and we are adding our exposure there because that's where the demand softness is already reflected in the stock price. But I think that as the economy does well and as inflation comes down, consumer buying will come back. And therefore, in some areas of discretionary consumption, we see an opportunity where stocks haven't done well over the last couple of quarters.
Is there more scope in spaces like real estate? I ask because, many of these names, whether it's macrotech developers, prestige estates, are already at fresh 52-week highs. And the demand over there has been exceptional too. More scope here for stock market investors in real estate companies?
Oh, yes, Sonia. I think we don't have exposure to real estate, but I think, real estate will do very well. That's a sector, again, which I mentioned is part of the earlier block where it did very well between 2003-04 and 2007-08. And I think that will repeat itself. And there are several ways to play that. You could either buy home improvement companies, or you could buy housing financiers, or you could buy cement companies, right? Or you could just straight away buy real estate. So it really depends on each investor's objective. But on the whole, I think this is a sector which will do very, very well.
All right, Hiren, any view on the pharma space? Select stocks have come back in style. It had a lull for close to 5 years, the headline index. But in the last year, the recent past, we've seen some bit of outperformance from a couple of these stocks. Case in point being a Divi's Laboratory at around 2,600, no one was looking at it. Suddenly, the numbers showed some bit of sequential improvement and the stock is off to the races. Anything looks good from there?
So I think, Nigel, pharma is a pretty tricky sector. There are the API manufacturers, and then there are the generic companies, and then there are the CDMO companies. So it's a pretty varied opportunity set. It's difficult to take a call on the entire sector as a whole. But again, I think you will have to be very, very stock specific there. Our focus in pharma has largely been on the CMS and CDMO space, where we think that these are businesses which are less cyclical, less prone to generic price competition, and these trends are fairly secular. So we like companies like Syngene, for example, which we've been holding in our portfolios for a very, very long period of time. And so you have to be picky and choosy in the pharma space. But I'm sure there are opportunities here as well. There were a lot of dislocations during COVID. They did phenomenally well. There was a part of the business which was almost one time during COVID, and then after COVID, when there was a high base to reckon with, and after that, we've seen a lot of these companies really correct because of higher raw material costs, falling margins, and those one-time revenues could not be repeated. I think once the base gets corrected, then probably it would be a good time to look at some of these companies. But as I said, we've been more on the CDMO side, which is more secular.
Right. I think we lost the line there with Hiren. We'll try and have, we'll try and have him back in just a bit.